Hello, and welcome back to the main stage here at Lending 3.0. Right now, we are going to talk about data and decisions powered by data and its role in the next generation of lending. And we have a really great panel here for you today. So I'm going to introduce them very quickly, and then I'm going to start in with our questions. So we've got Yaron Shoshani of Ezbob, Tom Renwick of Adam Bank, Gareth Rumsey of Thin Cats, and Andy Piggott from Metro Bank. So we've got a nice mix of tech and bank here on our panel. So we'll have a really great discussion. So welcome, guys. So of course, we're going to talk about data. And we're talking about the evolution of lending. And there's been a lot of great sessions here today. So I really want to ask all of you as kind of an introductory question. When you're looking at the changing needs of society and digital product offerings that alter customer demands, we're living in the age of open finance. Everyone's living in the age of a global pandemic, which is changing a lot and accelerating a lot of progress. Has data kind of kept pace with all of these changes that are coming around us right now? I mean, what talks about data quality and sourcing always come into the mix whenever people talk about the role data plays in systems and analytics. So I'm really going to start with Andy from Metro Bank. Is the data we're using now, is it up to scratch? Has it kept pace with all the massive changes that we're living through right now?
Thanks very much, Liz, and thanks for having me on the panel today. To answer your question, I think data has come a long way recently, and it's evolved significantly. What I would say has not necessarily kept pace to the same extent is the insight associated with that data. What I mean by that is there is obviously a huge amount of data out there that can be captured now, and now more than ever before. So open banking, open finance, as you talked about, is a great example of that. The current account turnover data that we can get from credit reference agencies and so on, I think is a great step forward. And I think the industry is trying to utilize that data to make more effective decisions. But if you look at the majority of lending that's done in the market still today, it's generally just the same data as before or new data going into the same old processes. So human decisioning, manual processes that don't necessarily really properly leverage the insights that could be generated from that data. And it does feel like there's a real opportunity for us to change things and come up with propositions utilizing that data to make them much more customer centric.
No, I think that's a really good point. We'll probably get into that a bit later, whether it's either old data or old systems. So I'm going to move on to Gareth now. It's the data, has the data kept pace with everything that's going on in the industry right at the moment?
Yeah, I'd really echo what Andy said. I think if you probably all heard statistics like the fact that 90% of the data in the world has been created in the last 2 years. So I don't think you can really argue that data isn't keeping pace with the speed of change elsewhere. But the problem with that is that you need time to really wallow in the data, to understand it and to drive those insights, as Andy was saying. You can't simply take new data, whether that's current account turnover data provided by credit reference agencies, whether it's open data, and just assume that you can drop it into whether it's existing models or new models without having spent the time to properly understand the provenance of it, understand the nuances of it. I've been using filed account data from Companies House for 20 years, and I still discover new things about it on a sort of a weekly basis. So I think it's not the data itself that's struggling to keep pace. It's simply you need time to really wallow in that data to be able to use it to its full effect.
So I'm going to move on to Yaron now for our if you can sort of add your comment to our introductory question about whether data is really keeping pace with the lending industry and what it's going through.
Thank you, Liz. So I will say that it's not just the data; it's how real time is the data, and I think that this is the main difference of what we're trying to see and look right now on the market. We understand that the traditional data today is not good enough, and we're looking for up-to-date information, online information, something that can really reflect the environment today. So I think, yes, there are much more data sources that we can consume, much more data that we can get into analytic systems. But I think that the quality of the data is still under question, and I'm asking myself if we have enough real-time data that can really help us and support us when we need to take decisions.
Yeah, no, I mean, all of your answers are really we're gonna fill out in the rest of our discussion, but sort of keeping with this sort of opening broad question, I'm gonna go finally to Tom. What is your view on how data is keeping pace with the changes and the evolution in business and technology we're going through right now?
Yeah, I think it's done more than just keep pace. I think it's instigated a lot of the changes. I think if we look at traditional bank ownership, and I use kind of ownership in inverted commas, of customer data, historically that's given large incumbent banks a competitive advantage in terms of pricing and risk scoring. Historically they could observe much better income, cash flow. Look at the existing loan performance than other lenders. And we've seen, I think, particularly in small business lending, some of the data asymmetries between lenders and would-be borrowers being particularly acute. If we look at the last 12 months, which have been undoubtedly challenging, as I'm sure we'll discuss in time, basing a credit decision based on statutory annual accounts now is relying on what's reprehensibly out-of-date data. Echo the previous comments there that we need real-time data-driven decision-making in times like this. We're starting to see that with initiatives like open banking. So, faster, better credit decisions, mining real-time data to derive income and affordability, if you have the systems and processes to utilize it.
So I wanted to move the conversation a little before we get into some, technical issues, but more of a sort of society question. Whenever people talk about real-time decisioning and quicker decisioning processes, and looking at how better data sets and open banking and open finance has kind of changed the way we as businesses and people interact with financial services. What's often brought up is that these advances are bringing a more inclusive lending environment, offering lending and credit to more tailored to people's lives or to, more reflective of their true risk profile. I sometimes get a bit cynical, a bit skeptical and thinking, has that actually happened? This more inclusive lending environment, because we now have better data sets and real-time analytics and open finance. So I'm going to go to Yaron first. Are we seeing a more inclusive lending environment because of these advancements?
So I would say the answer is yes. I think that it's all about expectation, about the fact that the end user today are expecting something which is a bit more tailored, a bit more personalized, and the system are moving within the same direction, and they are trying to take the data and use the data in order to offer something which is really tailored to the need of the business, to the need of the end user. I think that from the end user perspective, people are expecting to this experience. They are used to Netflix and to Amazon, and the experience is much more tailored and personalized and fast and quick and very easy to understand what are you doing and why you are doing it. So I think that if you look on the movement within the different system and different solution today, you can see that this is exactly what the banks are trying to do and the alternative lenders are trying to do, is to take every request and every demand and try to give the best solution for each demand.
Excellent. So Tom, I'm gonna move on to you, because I know Adam Bank is a digital bank, and are you seeing a move towards a more inclusive lending environment?
Yes and no. I think the kind of the adage is, isn't it, that the less information you know about something, the more you have to price in the risk of the unknowns. And I think we're getting to a place where a broader picture of an applicant's risk profile is enabling lenders to increase acceptance rates, reduce false negatives, and allow in many cases for a better assessment of fin-file applicants and use some of the open data sources. In that regard, I'm confident that there'll be a broader access to the kind of financial ecosystem. However, I think you're equally right to be cynical. There are still 1.5 million or so adults in the UK that have no current account or e-money account. you have 10 million or so that have low digital capabilities. So as we talk, as we will today about new innovative types of unstructured data, machine learning, NLP, we can get very self-absorbed. It's definitely possible that the nature of digital financial execution is exacerbated by some of the changes that we're seeing, and we need to ask, what are the unintended consequences for people that aren't in a position to share the data or don't want to. In the future, I think possibly owing to the fact you'll see a reduction in cost of serving these businesses, and typically it's been a really high cost to serve industry. Customers that are willing to perhaps share a combination of those digital and real-time source of data benefit from more favorable pricing. There are already some lenders in the market, for example, that offer cashback for sharing open banking data. So it's a really, really fine line to tread.
Yeah, no, it's interesting. So I'm going to move. I'm going to move to Gareth now. With all we're seeing, especially real time and really sort of shorter decision timelines, are we seeing a broader, more inclusive lending environment? What are you seeing, Gareth?
I think there's two aspects, I guess, to inclusivity. One is the one that Tom was just talking about, which is in the pre-digital world, if you like, there was a whole raft of credit invisibles, people as consumers as individuals and small businesses that hadn't filed any accounts yet, where there was nothing known about them, and they were basically excluded from lending products almost systemically. And I think the move to digital has definitely helped that. In my old role at Experian, we were very actively trying to reduce the thin file population. Within fintechs, we don't really have that kind of issue in the sense that our borrowers are mid-market firms. So there aren't any thin file customers. They're not credit invisible, that they are out there, they're visible. But I think there is still a population of underserved businesses, if you like. And I think that will always be the case. Whatever you put in place, there will always be populations that, for whatever reason, drop out, and there aren't products which are perfectly suited or tailored to them. So we find in particular that the banks are maybe not fully serving the growth business population, businesses whose growth is maybe eating into their profits, cannibalizing their balance sheet, businesses that don't have any tangible lendable assets. So you're essentially lending against future cash flows. Again, this can be really tough for, if you like, the more traditional banks to lend against. So I think there is an increase in inclusivity, but there's still more to be done.
Yeah, so Andy, the reason why I left you last to answer this question is, Metro Bank of course has a physical presence on the high street. It's almost on this panel, could be the traditional bank, although it doesn't have hundreds of years behind it. Have you seen a change with business customers and having a more inclusive lending environment?
So I think theoretically this is absolutely the direction the industry should be going in, and I think we are going in that direction, but I think we're still quite a long way from really realizing that, and that's across both lenders with physical presence and purely digital lenders. And I think it's also true across both personal consumers and business customers as well. Clearly, getting a broader set of data should allow you to get comfortable lending to customers that you weren't comfortable lending to before. I do think, though, at the moment, and particularly, and I'm sure this won't be the last time today we talk about the impact of COVID, I think that has increased the level of nervousness among lenders. And so I think there is an increased focus on managing credit risk exposure, which tends to default back to what is known and what has been proven to be effective at discriminating for risk in the past, even if, and I might come back to this later, even if that's not necessarily the best guide to what's going to happen in the future. I think when there is heightened nervousness about the broader economic environment, the willingness to take a risk on new data sources to be more inclusive is perhaps lessened. I think that's something that the industry needs to overcome quite quickly, though.
Yeah, I wanted to further the conversation, talking about using this data to really tailor a personalized service, especially for for businesses. And I wanted to maybe have a discussion about what that really means to have a personalized service. So I'm going to go to Tom, because I know in your last answer you talked about, how much information do you need to sort of measure that risk and calculate that risk. So Tom, what does it mean to use this data to offer a tailored lending service to businesses?
Yeah, I think it's worth stepping back for a second. I think if you look at the market today, the vast majority, I think the CMA back in 2015-16 reported that about 75% of businesses go to their primary business current account provider first when looking for a loan. And there's three reasons for that. The importance of the existing relationship is one, the perceived time and effort of applying elsewhere, but perhaps most importantly, this belief that their business current provider possesses a greater understanding of their financial history. And so I think at Atom, one of the things we're looking to do is, and it goes to the heart of our successful PCR award, is about reimagining the provision. So let's move away from product push towards more contextualized, personalized smart lending. So that's offering responsible and informed solutions at the right time. And to do that, we're placing at the heart of our kind of business propositions the integration of data, of open banking and management account information in particular. We're looking to categorize this, we're looking to enrich this, we're looking to pay that back to the customer. I think particularly when you look at last week's FCA announcement, their review of the 90-day AISP reauthentication, that's a significant opportunity to overcome some of the data asymmetries that have plagued the industry for a while. But you've got to earn the right to have that data. You need to be a kind of fair value exchange with the customer. That's why we're looking to provide it back to them. But if you have that kind of privileged access to data, if you have access to more typically unstructured data, it helps us better understand customers. And that ability to understand, to continue to monitor customer needs, to preempt borrowing, and to react in real time to changes in behavior with actionable nudges, with personalized solutions in the moment, I think is where the industry needs to go into dynamic personalized products. We're looking at products that are tailored towards small business cash flow, a repayment schedule that's reconciled with the predicted income profile of that business. And all these things are eminently possible. They just haven't been done before.
Yeah, I mean, excellent. I'm gonna move on to Andy now, because I liked when you spoke earlier about sort of this period of anxiety that we're in right now. But sort of moving on from that, in creating these personalized services, how does a bank work with that, and how do they offer a tailored services to business?
Yeah, I think agree with a lot of what Tom was saying just then. I think more granular data should genuinely enable you to properly understand a customer's needs much more than the historical way of understanding customers has been, as well as understanding the risk that you're taking in lending to those customers. So transactional data, I think, is a great example of what could be used to get a much greater insight into a customer's need and a customer's risk profile. So their eBay or Amazon marketplace transaction history, I think, is a really useful insight to understand more about consumer spending habits to generate those properly targeted propositions. I think the other really exciting opportunity is about allowing lenders to become more proactive as well. So rather than waiting for a customer to come to you to say, please, can I have a loan? We should be able to anticipate when a customer might require a finance product, often before they know it themselves. You obviously need to be quite careful with that. It could come across as a bit sort of big brotherish if you're really getting in ahead of customers coming to you about it. But I think as long as it is genuinely used to help customers, it should be a really positive thing as long as it's positioned properly. So that kind of additional transactional level data to enable us to get on the front foot to help customers, not necessarily with a sort of traditional product set, but with a broader, more innovative product set proactively, I think could be game changing.
Yeah, I'm going to move on and maybe to ask Gareth, because I know that ThinCats, they work with sort of mid-sized businesses. Are you seeing that change? Are you seeing that change with reacting to the specific needs and sort of in redetermining the credit worthiness and risk profile of these businesses in this space?
Yeah, I think in terms of the reacting to the business's needs, it's something that we've always done. It's just a nature that have relationships. We're not trying hundreds of thousands of businesses. We are lending to hundreds of businesses and have proper relationships with each of them. We have our business development managers who are physically out seeing those clients. We have the underwriting to look into the full financial forecasting of that business. So I think in terms of tailoring of relationship, but I think in terms of the looking rather than just relying on historical data and saying, this business been able to make its repayments, and is it willing to make repayments? Move the future looking, will it be able to make repayments in the future?
Okay, excellent. Excellent, very good. We had a little bit of technical issues with you on that, but I think we got most of what you said, and so we'll make sure that you're better heard for the next question. But I'm gonna maybe move on to Yaron. I mean, especially with the customers that Ezbob works with. I mean, are we seeing a change, especially in the SME space, on what determines creditworthiness?
So yeah, the answer is yes. I think that again, as exactly as Andy said, we are looking for more information and more data. I even will call it even as an ecosystem. It means that you don't need to stand and to think about the bank as a standalone entity that someone just get in and look for some kind of financial product. Exactly as Andy said, it's more about identifying the needs, looking into new data sources that were not used before. Again, eBay, Amazon, information that can help you to understand the business better. And I think that on the other side, what is also important is a flexible system. It means that you need something that can actually get the information, but can actually react to the data, can change the policy, can change the result, can change the risk appetite, can change the risk profile. And when you have the right system in place and you have the right data sources that can represent the business, then together you can actually lead in something much more personalized. You can see in many systems today, there's like a new layer of machine learning and AI that can actually absorb a lot of information, thousands of data points that they can be organized in a very easy way. And based on that, actually to offer the best offer for the end user. Again, if I'm looking now on our clients, and again, one of our clients is sitting in this panel today, I think that the demand from the fintech today is to be flexible, is to give the bank the flexibility it needs in order to react fast to these new data sources, to these new demands from the market.
Excellent. So I wanted to move on a little bit about, and some of you have touched on this a bit, about specific pain points for the SME sector, in regards to lending, cash flow, changes in business climate, throughout the year, seasonal businesses. So maybe we can get sort of an idea of what are some of the biggest pain points you're seeing in this sector when it comes to loans and credit and lending. So I'll start with Andy with this. What are you seeing from your business banking clients?
So cash flow that you identified, I think, is a really critical one, and I think the level of understanding of customers sometimes around how to manage that cash flow and what products can help manage that is not sometimes there, and that's not customers' fault. I think that's the industry has an opportunity to step up on sort of the education of around what those products can be used for, and indeed the sort of simplicity of the products that could be on offer to help customers manage that cash flow. I think it's also it's hard to talk about this without thinking about the impact of COVID again, because I think it's brought this as a specific pain point right to the fore for many customers. So even customers who may be used to dealing with volatility and cash flow on a seasonal basis, there's been a whole extra layer of volatility in cash flow over the last 12 months with the various lockdowns and so on. And I think that's meant it's been incredibly difficult for customers to properly manage their cash flow, and therefore also for lenders to assess that as well. Again, we would typically look at historical cash flow performance as a guide to future performance, but there's a question about how relevant that really is in the future, given the significant changes to the environment.
Yeah, I'm going to stay with you for a bit because I wanted to have a bit of a follow-up question, Andy, which sort of combines my next question. All of what you mentioned, that journey needs to be digitized in some way. What are the barriers to digitize that journey for the customer side?
So a couple of thoughts on that. One is, I guess, the extent to which digitization and automation are interchangeable, and I don't think they are. So I don't think digital necessarily means automated at every step of the process. There are parts of the process which make eminent sense to have sort of straight through automated digital journeys in place, but there are other parts where it's not necessarily desirable. And I think to bring that to life, the other point on this is, if I take fraud as an example, and the experience we've had through the bounce back loans scheme that we've participated in over the last few months, our aim has been to have a really straight through digital process, and for the vast majority of the process, we've achieved that, and that's resulted in some fast outcomes for customers. But fraud is a really difficult one. You're always going to get some bad guys out there who are going to try and take advantage of any process, and sometimes there is no substitute for having a human review of some of the transactions before money goes out the door. So I think fraud is a specific area that I would. Yes, we should absolutely be looking at opportunities to make it as efficient as possible, but fully automating, digitizing that is risky.
So I'm gonna go back to Yaron now. I mean, maybe to go back to that earlier point about what are the pain points that you're seeing in the SME market, and what are some of the barriers to digitizing that journey. So Yaron, what are some of the pain points you're seeing?
So I will start with something which is much more basic, which is I'm starting with the accessibility. It's for example, the working hours. I'm running a small business. It's very difficult for me to come to the bank and to provide all the information that I need. I really look for something that can really operate the best it can, over weekends, overnights. I can tell you that one of the pain point is going to be the answer, how fast I'm getting the answer. The expectation is to get the answer immediately, and I can tell you based on our experience that people are willing to pay more. You can increase the interest if you can give them just the answer in the speed they're expecting to get it, because they need the money now, especially when you talk about working capital. So I will say that, again, based on our data, by the way, people for small businesses are applying for loan over lunchtime, evening, weekends. And this is the expectation. I think that the accessibility is very important for them. Second, I think they're looking for a way to demonstrate the business performance. They want to demonstrate in a very easy way, to provide all the needed information in a very easy way, and they're looking for something that is going to make it easier for them over mobile, over the web. And as I said, they are willing to pay a bit more for that. This is based on our experience.
Interesting. Yeah. So I'm gonna move on to Tom now from Adam Bank. For the clients that you're working with, what are some of their biggest complaints? Where's their biggest pain happening?
I think there's a lot to be said about time to cash. So we talked a lot about decisioning, and decisioning now can be pretty quick, actually, depending on the loan type. But we need to look at the entire journey. You could be looking at, depending on the security type, time to cash that's measured in months. But so what's important to remember is the lending type. So your lender is only as fast as the slowest moving part. If there's any security involved, to say that there's some antiquated elements of that journey is an understatement. This is a panel predominantly about business, but I just completed on a house purchase a couple of weeks ago. It wasn't a complicated purchase. There was no restricted covenants. It wasn't built into a coal mine, and yet it took 6 months. And when you break that down, about 4 or 5 months of that was with conveyances, the land registry. It's completely archaic. So you're only as fast as the slowest moving part. At Atom, we've processed mortgage applications through from full application to offer in 14 seconds. We'd love to get to the point where that's the norm. But other kind of aligned industries need to move with us as well. And particularly, I think, when you're looking at legal, digital identity, anything that can speed up that exchange process in both businesses and retail customers is really important.
So I'm going to stay with you then for the follow-up question, which is, what are the barriers to speeding up that process? What are the barriers to digitizing that customer journey?
Yeah, and to be fair, when you look end to end at the entire journey, I think as an industry and as a kind of broader fintech ecosystem, I think most elements of it has stepped up to the plate. I think digital applications are the norm, digital KYC, KYB, decisioning, reporting, AML. It's largely all now streamlined and automated. It possibly necessitates at this stage a broader, particularly for some of those security types which are a little more complicated, broader government initiatives. And they've been working with the land registry for a while on their digital streets program. Something of that kind of ilk is what it's going to take to move the needle for secured commercial mortgages.
Yeah, so I'm going to stick with the pain points question and move on to Gareth. I know whenever people talk about the SME market, there's a lot of focus on the S, on the small part of that. But I mean, what are some of the pain points you're seeing with the companies you work with? Are they different than the smaller businesses? And what are you seeing with the mid-sized businesses?
I think that there's similarities in the sense that speed still comes into play, but it's not speed in the sense of getting a loan out of the door, getting a decision in 14 seconds and getting money out of the door in 24 hours for working capital. It's much more speed of getting to an indicative price that they can then compare, because typically they'll be shopping around or going through an advisor, and we work a lot with the advisor community. So they'll be shopping around. So it's getting that indicative price. And I think then the other thing is around the flexibility and really understanding their business and how the loan is going to be used and what the repayment profile needs to look like. It's not a straightforward 4-year amortizing loan. It may be that the first 2 years are interest only because it's going to take them that long to actually become cash flow positive as a result of the loan. So I think speed and flexibility are the two key things, but they're measured in slightly different quantum, if you like, to what the smaller micro end of SME are looking for.
So they want speed, but they don't need it that fast. Then you're saying?
Yes, exactly. Yes, speed, but not lightning speed.
Excellent. More time to do business. So we've got about 10 minutes left of our discussion, and I really kind of wanted to, unfortunately, talk about COVID, which has just impacted economies, businesses, people's personal lives, all over the world. But a lot of people have talked about the pandemic as almost accelerating a lot of innovation, especially in the financial services space. And of course, we're gathering a lot of data and analytics from the global pandemic. I just want to know sort of, how long is that going to impact the industry? All of that data, all the analytics gained from this period of time. Businesses that are struggling, businesses that are surviving, businesses that are thriving. How long is that really going to impact the industry? So I'm going to start with Yaron here on what your views are.
So I think that there is a demand for money, for capital. The demand is always there. I can also say that if you look on the bounce back loans and the average loan size within the market there is a gap and someone needs to bridge the gap. So I think that we're going to see really quickly more and more demand coming back to the market. I think that as a result of that, banks will need to find, I would say, not a better, but a new way to evaluate businesses and to be able to react, as we said, to this session, to the data, and to look for, I would call it, less traditional way of evaluating and use the data that was gathered in order to take smarter decisions. I think that one of the things that I can identify is that there is much more demand for fintech to partner with banks to provide the solution within the right speed, within the right pace. So I think that we're going to start and see fintech joining bank and trying to help bank to provide this demand and to solve the problems that are related to the data and the data collection and the fact that the market is look totally different right now. And once the experience that can come from the fintech and the experience that can come from the bank will join together, I think that what we're going to see is everything start moving back to normal.
Interesting. So yeah, so I'll move on to Andy to get your views on our final question. You know, how long are we going to feel the impact of all the data and analytics that we've gained during the COVID era?
Yeah, it's a massive question, Liz, and a massive unknown, I think, without a crystal ball. But I think we do know that the impacts on SMEs have clearly been significant, as you said in your introduction to this question. Many have been hit incredibly hard, while some have thrived in this period. As Yaron talked about, I think the government loan schemes have also been a massive lifeline for many customers, but that does also create a bit of a challenge as well in understanding what the impacts are going to be longer term. So to what extent have customers taking a bounce back loan or a CBIL, are they going to be viable in the longer term after the benefits of that loan have worn off? What I would say though, and I think I agree with Yaron here, that those businesses who do come out the other end of COVID could be in a really, really strong position to capitalise on what will hopefully be a good period of economic growth. So I think if you can get the right data to determine who to lend to, and that's not easy because it's not necessarily the data we relied on previously to determine who are the right people to lend to. But if you can get that data, there could be some really great opportunities for lenders to help customers and really support the economic recovery, which I know we're all hopeful we'll see.
Yeah, I mean, I'm worried that maybe you know, in the future, some businesses might be it might look poorly on them that they maybe took out a COVID loan, a bounce back loan, but we'll see you know, sort of the market attitude going forward. So I'll move on to Gareth now. You know, how long do you, all of this, you know, analytics and data that we're gathering right now on the different, you know, behaviors and survival of businesses, how long are we going to feel that impact? And how will we sort of use that data in the future?
I think from a pure data perspective, it's almost a silver lining to a recession. I remember when I first started work back in the late 1990s, for the first decade of my career, we were almost wishing for a recession because we had no data on what happens when we go through a recession. You know, there wasn't data around in the early 1990s or the 80s recessions. And then, of course, eventually we got the 2008, 2009 financial crisis. The big, well, we say the big one, but actually the impact in terms of small business insolvencies was relatively small. And I think probably for decades, maybe centuries to come, the COVID era, as we're calling it, will almost be seen as the baseline. You know, and when you're trying to run stress tests and trying to look at, you know, economic scenarios, you know, what's the potential downside? How bad could things get? You can almost measure it in terms of relative to COVID, because how can anything get worse than this? You know, no stress testing ever takes a scenario where huge swathes of the economy simply haven't been able to generate a pound of revenue for months at a time. You know, that was just, you know, something that no one had ever thought of. So I think you know, that this will be a really interesting baseline for the extent to which measures taken by government, by lenders, and so on can actually mitigate the impact of a recession. And you can be pretty confident. You know, you almost measure it in terms of, is this a 50% of COVID recession or a 80% of COVID recession? But it's not going to be worse than that.
Yeah, no, I'm glad you brought up that point about, you know, using this data in the future, even though, you know, we might look at the COVID era as not a great time in our lives. You know, when I look back at the crash of 2008, one of the problems was that there wasn't a lot of housing data available for crashes, especially in the US. You know, having that data available will hopefully help us make better decisions in the future. So Tom, we're gonna close off our discussion with you. So you get the final COVID data silver linings. How long will we use this? How long will this impact our industry? Question. So Tom, I'm going to go to you.
Yeah, I think Gareth's right. I think the last 12 months have been invaluable in terms of providing a data set that previously just didn't exist, and even the worst case stress scenarios would never have envisaged. I think what's perhaps more interesting as well is the next 12 months. Actually, what does business recovery look like, which will be just as valid. But I think if you can think back to those kind of pre-pandemic days, these weren't halcyon days for business lending. There's still been a large and sizable business lending gap, particularly for micro and small businesses. And whilst we've seen CBILS and BBLS provide a significant one-off increase in the last year, some of those structural gaps haven't been addressed. I think perhaps the worry is that you see some retrenchment trends in the next couple of years. But you look back at the kind of cyclical lockdowns, the business restarts. Lenders have had to monitor credit risk with much more limited visibility than they've ever had. And it's represented, I think, a fairly compelling opportunity for many of them to utilize their systems, move away from how they historically managed credit risk to a future state. A lot being said today about reviewing real-time financial data. I think those that have done so and have placed data really at the heart of their journeys have a really, significant advantage and opportunity to capitalize in the years to come.
Interesting. No, really interesting. Well, data underpins so many financial decisions and parts of our lives. I want to thank our panel, Andy, Yaron, Gareth, and Tom for our discussion. And stay on the main stage for more sessions for Lending 3.0. Thank you very much.
Thanks very much.
Thank you.